welcome to Markets at Money Control. I'm Santosh Nair. Just in case you haven't started investing in mutual funds or are wondering what to do with your existing investments, I have with me in the show Kaustubh Belapurkar, Director Fund Research at Morningstar, who will be giving you some handy tips in a short while from now. Hi Kaustubh.
Hi Santosh.
Thanks for joining us.
Thank you.
So before I get chatting to Kaustubh, here's a quick wrap on the markets. The indices ending lower today, geopolitical tensions weighing on market sentiment, and the Sensex shedding about 147 points. The Nifty managing to close above the crucial 9900 mark. Overall, global markets were quite weak, and that had a rub-off effect on Indian shares as well. Among the prominent gainers, metal stocks, most of them did quite well. IT and FMCG stocks were a drag on the indices. The advance to decline ratio was about 1:1, so one share rising for every share that fell. Overall, the mood remains slightly cautious for the time being. So Kaustubh, the story of the year so far has been mutual funds. I mean, clearly they have been the saviors, and about 90,000 crores of net inflows till July.
That's right.
Okay, so what's the broad picture there? Where is the money coming into?
So Santosh, I think the interesting thing is a lot of money has been coming in from retail investors into equity funds. So if you look at it, first-time investors, the number of folios are growing. Cities not just like Mumbai, Delhi, Bangalore, but the Guwahatis, the Ranchis, the Indores of the world. You're seeing investors coming in to the equity markets for the first time through SIPs and a little bit of lump sum investing, and that's really been the trend and the story so far.
So there's also a general feeling that it's largely because of demonetization and the government's other measures to crack down on black money that's driving mutual funds, that's driving the inflows into mutual funds. At least one of the key contributors. What do you think about that?
So definitely, I think that is one of the stories where you can see that money has, post demonetization, there's a lot of money that's coming into the fund industry, especially on the equity side from individual investors. But we believe that this is only the start, really, in terms of the demon money coming in. There have been other factors that have been going on. The regulators being mandating investor education is one of the key pillars of driving investor sentiment into the market. I think that's been working well. AMFI, which is the the body of the mutual funds, that's really been spending a lot of money. The mutual funds themselves have been spending a lot of money reaching out to investors in smaller cities, and we all saw the campaign Mutual Fund Sahi Hai, which they ran quite aggressively just to get people understanding the finer nuances of investing in funds, trying to demystify what really funds would help them do.
So what's the nature of the money that is now coming into mutual funds? What's the broad trends that you have been picking up?
So the first thing I think which we spoke about is systematic investment planning, sort of flows, SIPs as we call them. There's a lot of money, and that has been increasing month on month. So as we stand today, it's almost 5,000 crores a month through SIPs. To our mind, this is slightly more sticky money. When a retail investor comes in, he would tend to buy an SIP for a couple of years, 3 years, and continue to make those allocations month on month into the funds that he's chosen. So it's a little more sticky than lump sum money, which could come and go out depending on the way the investor looks at it. So I think that is a fairly significant proportion, and as we can see, that's really propelled domestic money being invested in the markets, where we've seen foreign institutions who've been coming in, going out. August was a classical case where they did pull out a fair bit of money from the markets, but it was the domestic money that let the markets kind of remain range bound.
So coming specifically to systematic investment planning, now we're seeing good inflows through that route. Now, if you look back to 2007, 2008, you saw some good inflows into mutual funds, and you saw steady money flowing in through SIPs. But what happened is, after the meltdown, many people stopped their SIPs, and for the next many years, you actually had net outflows from mutual funds.
Sure.
Now, fund managers are saying that the investor has certainly matured this time around, and you might not see such a scenario even if the market were to correct sharply. What do you think about that?
So I think a couple of things which have happened which are good, right? So that time the investor education wasn't up to the mark. There was still understanding what mutual funds stood for, what equity markets were. That is the first thing. The other thing, the color of money has changed. So like we said, SIPs is more sticky money, will tend not to pull out the money in a hurry. The other thing that is important to point out is the kind of funds that have been getting flows. So if you look at it back in 2007-8, it was largely the cap good infrastructure themed funds that saw a lot of flows, because that's the sector that had done extremely well during that bull run of 2005 to 7. But this time around, it's more diversified money that's coming in. I think that's, I would say, kudos to the entire industry, the financial advisors, who've been explaining to investors that while you might have certain themes that will do well at particular points of time, but it's really your diversified equity funds where the manager makes his bets according to what he thinks is the right part of the market to be invested in. That's really the core part of your portfolio where you should really come into a more diversified fund. So that's definitely helping in terms of where we expect that investors will tend to stick around. And I think the other important thing to point out is people who moved out their money in a hurry in 2008 are now seeing that, okay, we've seen a couple of market cycles, and we know that if you stay invested for the long time, equity is a great asset class, which is something which investors weren't cognizant of back in 2007-8, but I think that is now slowly changing.
So let's say somebody who hasn't invested in mutual funds so far, how should he go about investing money there? Okay,
sure. So I think it's a very interesting time to be an investor right now. Obviously, the markets have been doing extremely well, and the returns look great. But I think the one word of caution before we start explaining what we should do is that investors shouldn't just look at purely past returns and make their investments. The first, take a step back, try to understand what your investment objectives are. What is the time horizon you have in mind to make an investment? I'll give you a very classical example. If someone needs that money in a couple of years, maybe to make a down payment on a house or buy a car, and he thinks, let's invest in an equity fund and make great returns, I think that's not the right way to do it, because equity is a long-term asset class. We've seen that there have been dips in the market, and it can happen at any point of time. So I think for an investor, it's important to first understand what your risk return is, and understand what your investment time horizon, and accordingly pick the right asset class, be it fixed income, equities, or gold or other asset classes as such.
Okay. And what is your advice for investors who are looking to put money in sector-specific funds? Okay. How does one play that particular segment?
So that's a segment I would say it's only for the niche and the really savvy investors, because sector funds would come in while the returns can look great on a historical basis. It's a very specific call that you're taking on a particular part of the economy. For instance, banking stocks have been doing great, and they would probably be a pillar of the economy, but they can have their challenges as we've seen in the past. So if you don't have a view on a particular sector, I would advise any retail investor to steer clear of sector funds, rather go into more diversified equity funds. Sector funds would be for someone who understands that sector and is ready to take that risk associated with the sector, where he can make outsized returns, but at the same time his drawdown could be great if something goes wrong with that sector story.
Well, of course. And what about debt funds? Is it a good time to be investing in debt mutual funds?
Absolutely. I would say debt is again a very core part of every investor's portfolio, because what debt does, it gives more stable returns, and also there's liquidity. If you want money in the short term, like I was talking about earlier, a fixed income instrument is a much safer, so to speak, instrument to invest into. So if you want money 6 months down the line, you want money 1 year down the line, rather than letting that lie idle in your bank account, come into ultra short-term funds, which will give you a certain amount of return with much less volatility as compared to a riskier asset class like equity.
Now, there's also this misconception that debt funds don't pose any risk to capital. Is that really the case?
I'm glad you're bringing this out, because I think that's something which investors clearly need to understand, is that debt funds or fixed income, there's not necessarily a fixed return instrument. Investors are so used to investing in fixed deposits, and they expect that I will get my money back at the end of the period. But not all funds would be. You have an interest rate risk, and you have a credit risk. So there are certain kinds of funds which would take either one of them, both of them, or neither of them. So I think investors need to understand which are the kind of category of funds that would be suitable for them, depending, again, like I said, their risk-taking ability and their time horizon.
Okay, and now fund managers seem to be facing a problem of plenty. Some years back, they would say that they're not getting enough stable inflows, but now I think they're getting too much of them. So what are they doing with it right now? What are they buying?
Okay. So I think fund managers, and you're right, it is really a problem of plenty, that money has come in a big way, especially this year. and markets have obviously become expensive. So managers are stuck, that do you buy expensive stocks with, where the growth story is still intact, or do you really go down the curve and look for maybe lesser quality stocks? I think what managers have done so far, and they've been very prudent. So they've taken their time so when money's been coming in, they've been increasing their levels of cash so that they get some time to get the right stocks they want. And they're probably paying a slightly higher valuation, but they don't mind that, because in these kind of markets, you rather buy quality, even though it's a little more expensive, than buy something which could potentially run up, but the quality of the stock or the management could be dodgy. So I think managers have become much more selective. Their job has obviously become harder, but that's where the skill of the manager comes in, where you buy conviction, and you stick to that stock for the next 4 or 5 years at least.
So what are the sectoral trends that you have been noticing in terms of what fund managers have been buying?
So I think one of the trends that managers have clearly started doing, and that's been a trend I think for the last 18 to 24 months, is financials has become. It was already a large part of the pie, but I think increasingly they've been adding more exposure to that. So some of the good private sector banks, selectively some of the PSU banks, some of the housing finance companies, I think these are seeing a lot of action from managers. Another space which was on valuations, the metal sector, which was really beaten down, there they saw that, I think the bad part of the commodity prices started inching up through 2016, and that's where they saw that there will be, the growth will come back, and you will see a price correction, a price rise on the counter. So they did add a fair bit of metals in terms of additions to their portfolios. Where they've clearly been reducing exposure would be pharmaceuticals and technology. I think these two packs, because of the concerns on the growth and just the exports, they've really pulled their weightages down in these counters.
Well, thank you so much for joining us and sharing your insights, Kaustubh. And that's all that we have in this edition at Markets at Money Control. Thank you for watching Money Control.